Right.
Hello, and welcome to the Mayoral Community Forum for the City of Glenarden. I'm Mayor Cashenna A. Cross, and I am here with Ms. Jeffries. Ms. Jeffries is one of our Prince George's finest. She's going to talk to us about some of the things that she has found as far as financial literacy and financial peace that will bring us hope after the summer spending extravaganzas that we've been on. So I am so honored to welcome you. Ms. Jeffries, could you give us a little insight into your program and how you decided to start this business?
Absolutely. First and foremost, Mayor, thank you so much for the opportunity to be on this platform in front of all the lovely people in PG County. Thank you so much, especially representing Glenarden. How I came across this? Well, I'm a retired Air Force veteran. I'm a breast cancer survivor, also an author of No More Bad Days, which chronicles my breast cancer journey and life beyond. So I was always searching for something to do. My motto in life is to always be a part of something that's bigger than me. And it just so happens that a dear friend of mine shared with me about a place that teaches people about money and how money works. And the workshops and their classes and the resources are free. I thought, oh, well, I'm retired. I have all of my time to myself now after 26 years of faithful service. So I think I'll go and check it out. So I went to check it out. And as soon as I started hearing very powerful but basic financial principles, immediately I was very inquisitive and I thought to myself, I've been roaming planet Earth for 40 plus years and I've never heard of this before. My goodness, how many people out there in the communities needed to know this yesterday? So the journey started with me getting my education in place and getting things in order with myself first, and then also having a greater purpose that I was convicted to be a part of what I'm doing now, to be able to share it and pay it forward to the others in our communities.
Fantastic. And I acknowledge that when you were a young 18-year-old, you decided to start your journey with the United States Air Force.
Yes.
Now, you know, I'm also an Air Force veteran, retired after 20 years of faithful service. I thank you so much for your service to this great nation.
Thank you.
And upon entering that, you also had 12 duty assignments. You also were a part of Operation Enduring Freedom, equally as Iraqi Freedom. You had 26 years and 6 days in the United States Air Force service. You are a first sergeant and a personnel superintendent. So you know people.
Yes.
And what I really appreciate about your journey and where you're going now is that you have a track record of proven success and opportunities that were missed in the past that you can now help people in the future. So I am so excited to be on this forum with you. We are honored that you are the survivor. You are a victor in the fight against breast cancer. You know, you may not know this, but I also have a mother who unfortunately has gone on to be with the Lord, but she had a battle with breast cancer as well and was successful for, as I recall, more than 15 years. Wow. So I will say just, you know, we are in a journey together. And as a community, we are building back stronger. I thank you so much for your life, how your light is so shining, and we look forward to hearing from you today. So you have provided education to more than 700 families across the United States. That is quite impressive. And with that, over $20 million in financial assets being in communities and financial stability and independence programs. So what could you, as a financial advisor today, look at COVID-19 and what it's done to our families? How do you foresee us pulling into the future beyond the stimulus checks and where we are today?
Very good question. So the way I look at that, as far as us moving forward in the face, because COVID-19 hasn't gone anywhere. It is still here. it is still alive and well. And what I also realize is that there's still financial turmoil as a result of that. And one of the things, as simple as it may sound, but it is true, financial education. The program that we have, it brings financial awareness to the communities. Because, you've heard people say, I'm good, okay, what does that mean? Explain that to me. Okay, are you good because you have a six-figure income coming in? Are you good because you have that six-figure income coming in and it gives you this sense of security that, okay, I'm prepared for whatever happens? But we already saw that millions of people were caught off guard, 3 years ago? In March 2020, during the pandemic, the global shutdown, they were caught off guard. And literally people that have a six-figure income or whatever a good income looks like to them, they are literally just one paycheck away from being homeless. That's the truth. That's the truth. They are one paycheck away from losing their home to a foreclosure. They're one paycheck away from bankruptcy. So you have to get to the root of the problem. And it starts with education. It is possible that you don't know what you don't know. There was a lot that I didn't know, and I just learned what I didn't know at 40 plus years of age, long after I retired from the Air Force. So I had to go back to the basics. And a lot of people in the communities, they have to go back to the basics. Perhaps some people seem to think, oh, well, I got an IRA, I got my 401k going. Okay, well, a lot of people have a 401k, but they don't know what's in it. They don't understand it. They don't understand what their pluses are versus their losses. They don't understand the taxation categories that their money falls into. And all of that is the financial awareness that we want to give to people in the community so that, okay, maybe they did know it. It's like, okay, I'm good. Or it's like, well, maybe I guess I didn't know it. So it all comes down to the educational piece of it that will show people exactly where they are and where they can be able to go from there.
Super. And when I was, when I first got married to Mario, my husband, we actually went through the Dave Ramsey program under Now Word Community Church in San Antonio, Texas. And it was a great program, and it talked to us about these envelopes where you would segregate your money into little small pockets and envelopes, essentially. And so this envelope would be for groceries. This envelope would be for you to splurge, our summer splurge, as we've been talking. Mm-hmm. This envelope is for your church tithes and different things. This envelope is for school things. And if you segregate your money into those little envelopes, when the envelopes are dry, then that's the money that you had for that particular period. What would you say to something? I mean, it was a lot of work for us, so obviously we didn't continue it. We just had to discipline ourselves.
But you know what? You said the key word, discipline. Mm-hmm. And I want to tell you, I remember Dave Ramsey. You know what? I was actually in Iraq, and I was at Ali Air Base, Iraq. And we actually had a Dave Ramsey series that was being taught there. We did not, obviously, because we were in the war zone, we didn't come out of pocket to purchase any of the kits. But I had one mission when I was there. I said, my mission in life is when I go back home from this deployment, I'm going to pay off my vehicle. I'm going to pay it off. And that's exactly what I did when I came back after 4 months of deployment and from listening to Dave Ramsey, right? Mm-hmm. And while Dave Ramsey is good and it does hit on the discipline piece, you're absolutely right about that. It's spot on, the discipline piece. The other part that we have to hit on is the financial foundation. So that's our financial portfolio overall. The financial foundation, again, I did not know such a thing existed until I came to this company that I'm a part of almost 5 years ago. There are 4 major pillars that make up a strong financial foundation. And it's the protection, debt management, emergency fund, and investments. So the proper protection is at the very base of that. Why? Because picture a house. You build a house from the ground up. So everything that starts at the bottom, you even have to get a permit, right? You have to get a permit before you start breaking ground and putting in concrete and all of that. So you have to make sure that that foundation meets the requirements, meets the city, the state limitations, and all of those things, because it has to be built a certain way so that it can withstand through the test of time and turmoil and elements, the wind, the water, blah, blah, blah. And it's the same thing with our finances. We have to build it on something that's very strong, a foundation that won't break. Case in point, I heard another sad story of a young lady who died suddenly. Young lady left a child behind. Unfortunately, because she was not educated properly, the beneficiary information was done incorrectly. And now the family is having to scrounge for additional funds to be able to bury this family member. But if the protection plan that was put in place was solid and was something that met the goals and needs of that family, it wouldn't be a burden. So now they can be able to do other things. They can be able to build on their foundation because they have met the basic primary need of the protection piece. Then it's the debt management. A lot of people, they swimming in debt, Sister Cashenna. They want to get out of debt, don't want to be in debt, but they just don't know how. So we teach people about a systemic way to get out of debt. And then the emergency fund, hey, at least 3 to 6 months of your monthly income, you should have that saved up. You never know when the rainy day is going to happen. And then lastly, the investment piece, which I'm finding a lot of people are sleeping on that. Again, they're very comfortable, right? They don't think that they need to invest into their TSP for the government employees. They don't think they need to invest in their 401 or 401k derivatives, but you do, because you never know when you're going to need that. So
what type of investment do you consider? For me, for my TSP, I'm pushing 10%. And then when I get to within retirement age, then I'm going to go full max to allow me to, I think it's called double, triple, to save towards retirement. You know, my target goal is to have $1 million in the bank. That's my goal. So as we continue to press, how would someone with that type of strategy, what would you recommend as kind of an equation to help us get there?
very good question. So what I've learned from my own experience, the very basic thing is getting a financial review or a financial analysis, because you always want to check where you're at right now and where you want to be. And you want to make sure that you're reviewing all 4 pillars of the financial foundation. You want to make sure that your protection plan is still meeting your needs, or perhaps it's exceeded, or it's not meeting those needs or those goals. Maybe your goals have changed since you've had the protection plan put in place. Maybe you want to look at tax advantage benefits to be added on to the protection plan to build a legacy. You also have to look at your debt management. Okay, my debt is still pretty good. Oh, hey, I'm out of debt. So that's something that's excellent. Okay, now you're out of debt. What are you going to do with that increase in cash flow? Where are you going to put it? My mindset is always how I can help my people. When I say my people, I'm talking about everybody. How I can help all the hardworking people grow their money protected from further taxation and inflation.
Yes. Thank you. And you know, when you were talking about protecting it, I just want to make sure that it's known in this recording that the federal student loan pause is actually going to expire August the 31st of 2023. So the federal student loan payment and interest pause, that is something that, if you will, the Office of Federal Regulation here, the primary regulator to our state of Maryland, is advising our students that if you may be eligible for a Maryland student loan tax credit from the Maryland Higher Education Commission if you are a taxpayer and have maintained a Maryland residency for your 2023 tax year. And the applications were opened on the 1st of July, 2023, and they will close on September the 15th of 2023. So it's important that particularly our kids, as we're looking, as our graduates are looking at this federal student loan pause, that they make those applications. The repay options and all of that for student loans, are there recommendations that you would provide that will help students with high student loans become really debt free. Now, when I grew up, it said that's the cheapest loan you'll ever get. Leave that loan the way it is. Pay a little $200-300 and don't mess with it, because that's the cheapest you're going to get, a $75,000 or $80,000 loan.
Wow. So I'm so glad that that's good information. I actually wrote that down about the federal student loan pause that you just talked about. You know, I'm going to say this. What I want to say is that you can't go into a loan and expect not to have to pay it back.
Mhm.
Somewhere along the lines, Mayor Cashenna, a lot of people go into loans and they just sit back and they wait, thinking, okay, I know it's there, but I ain't gonna pay it. Somebody got to pay it. Somebody has to pay the loan. Now, having said that, that's something that we cannot get away from. When we talk about loans, we also have to be very cognizant of something referred to as rates of interest, rates of return. This is something that really dictates how long you stay in debt. So whenever people are making minimum payments on any type of loan or any type of debt, guess what? You're not going to get out of debt faster. You're going to stay in debt longer. That's just a fact. So when we realize that, and I realize that, so it's my job, it's my mission to teach people that. Now, having said that, I also work with people and say, okay, you want to get out of debt faster? Here's how you do it. You know, you follow something that's referred to as a debt roll-up or the debt snowball method. And that's basically somebody finding an extra $25, maybe $50 and add it on to that one particular debt, just focusing on paying more on that one particular debt, getting out of that debt faster, which is going to do two things. Number one, increase your cash flow. And number two, it's going to help you save thousands of dollars in interest that you otherwise would have been paying. So it's not going to happen overnight. Is that true? It's not going to happen overnight. It's through discipline, as you mentioned earlier, and with a plan of attack to help you get out of that debt.
And, you know, I was looking at this repayment options, and it says that students can take advantage of possible discounts to their interest rates. And they also can take direct loan borrowers who use auto debit can actually get 0.25% interest rate deduction on their loans. So utilizing that direct loan payment option, that's something that I found, Ms. Jeffries, was very helpful whenever I put my home loan or my electric bill and all that stuff on auto pay. And then I'll tell you something else about the electric bill, which is a very unique trick that I learned, you know, when I was exiting through the transitional program coming out of the Air Force. But put those mortgage payments and those types of chunk bills on auto pay, and you'll see a reduction, if you will, in that interest rate because it's a consistent, persistent. They don't have to pay for any check cashing fees, or they don't have to pay any credit card fees. Now, on credit cards for our youth, this is something that I'm doing with my girls. When they turn 16, my eldest is almost there. I'm giving her one of the credit cards that has a low interest rate on it, put her name on it as an additional user, which would then build her credit worthiness as she's completing high school and through college. So when she's out of college, then she's got 6-7 years of credit worthiness, which is excellent for starting off as a young adult. For my credit cards, I also utilize that for like my electric bills, because you pay your electric bill through your credit cards, then you pay off your credit card. That continues to build your credit worthiness and keeps your credit score up in the green. So can you talk to us about some other tricks of the trade, or are all those things that you agree with?
Those are all things that I do agree with. And I don't know if you noticed, but you just had me smiling from ear to ear because you said a word that I teach children when I teach financial literacy: credit worthiness. That is something that they do have to learn and to start building it and understand the responsibilities that come with it. You know, something very interesting that I learned about 3 years ago is a credit industry, the credit card industry. They actually label people into two different categories. You have the revolvers and transactors. The revolvers It's just that. Imagine a revolving door in a major office building. It keeps going and going as people come in and out. It just keeps turning, turning, turning. So people take that credit card and they keep swiping it and swiping it and swiping it and swiping it. And they carry that debt from one month to the next month. You know, maybe they'll miss a payment here or there, not paying it on time. Those are the revolvers. And then you have the transactors. I like to refer to my beloved husband as a transactor. This means that these are people who are very responsible with the use of their credit cards. You know, if they purchase something using their credit card, okay, no problem. They make sure that they pay that particular bill off before the end of the month. And guess what? When they do that consistently, they get rewards. That reward might be, okay, use your card. And guess what? That airline ticket that would have costed $300+ is now only going to cost you $12. So I do definitely agree with you wholeheartedly. But again, that goes back to education. That goes back to reading and seeing, okay, what kind of benefits are out there? What are the pros and the cons of those benefits as well? But we have to get a better handle on understanding how credit card companies work.
Mm-hmm.
So.
And I really appreciate you talking to us about the transactors versus the revolvers. And that's why they call it a revolving credit card debt.
Mm-hmm.
And it's the revolving credit card debt that drops your score, more so than a home loan or a car loan or a loan which has a end date in mind. So you would do better. And this is another trick of the trade that I learned. For loans that you are able to acquire under your good credit name, Navy Federal, for example, gives you $50,000 just on signature. And that's just a start out loan if you got great credit. Mm-hmm. Don't even have to be perfect credit. It just has to be good credit, right? 620 gets you solar panels, those types of credits, right?
Yeah.
You take that 50,000, okay? You put that into an interest-bearing savings account. Then you are able to pay off that 50,000 loan. And then you are able to see your 50,000 start to make you interest. And in this 5 years that you're paying that $50,000 loan off, it's sitting in the savings, earning you interest. Now, I'm going to do a quick search on what the current savings account interest rate, unless you got that right offhand.
Girl, please do. But I can tell you right now, the average rate of return is 0.25% if you're lucky.
Oh, my goodness. So we would have to find some type, well, I don't really do stocks or anything like that, but the best savings accounts, high yield savings accounts, that's what we want. Now, I'm looking at a few. Pacific Western Bank market account says an annual percentage yield of 5.25, and that was as of August the 9th. SoFi, SOFI, checking and savings, 4.5%. So Synchrony Bank has a 4.5%. Barclay has a 4.35%. So these are some things that you can look at. And let's do some quick public math, if we will. 50,000 plus, we'll just go 4.5%. Then your 50,000 is earning you $2,250 a year. And if we go times the normal loan rate, $2,250 times 60 months or 5 years, then your 50,000 by the time 5 years is done has earned you in excess. I'm going to say in excess because I'm just doing public math, right? $11,250 that you didn't have to do anything but pay your note off. And don't borrow against it. Don't use it. Leave it there for 5 years. Anyone can suffer 5 years of just seeing money grow. So let's just look at that 11,250 plus the same 50 that's still in there. Now you have $61,250. Now I'm going to add again 4.5% because we want to leave it there. Kids, this is great math. Now you're earning $2,756 a year. So while it's a cheap interest earning account, if you never touch that money and it continues to be a building market for you, keep in mind, interest rates could go down or they could go up, but this is a pretty good rate. You've just changed from $2,250. You've made $306.25 more per year. Just that one $50,000 loan. And that's something that I promise you, I wish I'd known when I was a freshman in college, because I've been working that long, right? Both my parents were deceased before I was 19. So my sisters and my brothers were my confidants and also my parental figures that I looked up to. But nothing really teaches you that. And that's why I'm so adamant about our young folks learning ahead, how to get ahead in life. If you think about it, we went from making $250 to now making $356 a year. So that's really good. And all you're doing is leaving that money in the bank and not touching it. If you decide to put just another $5,000 a year on it. So let's take that $5,000. And I like doing a little public math because it's cheap. Now, this isn't what it really is. In the end game, it's a lot more closer to like $80,000. And that's the truth. You could be a millionaire by the time you get your first 10 years of working experience done. How amazing would that be? Every time you get a bonus, take that bonus, live within your means, put that bonus in that same account, and then start thinking about your investments. So now that brings us to investments. What are your recommendations for investment?
Oh my Lord, I'm so loving this conversation right now. So I love what you just said. And I actually have to add, this is going to be an educational moment for our lovely listeners out there. There is something referred to as the rule of 72. Okay. What I have learned is that banks have their place when it comes to our money. They do. But if you want to grow money and you want money to double, quadruple, then there are other avenues to take. So we start with the rule of 72. I just learned this 5 years ago. The rule of 72 says you take 72 and you divide that by the rate of interest or the rate of return. So you gave two rate of returns here. I wrote them down, 5.25% and 4.50, I think, which two numbers that I heard. So let's say if somebody invested $10,000 into an account, and let's say that person had invested $10,000 and at that rate of return of 5.25%. So that $10,000 is going to double every 13.7 years because 72 divided by 5.25 is 13.71, blah, 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 blah. So that means that money is going to double every 13.7 years. Now, if you have the other account with the other rate of return, you put that $10,000 into that account that was going to give you a 4.5% interest, 72 divided by 4.5. Now the money is going to double every 16 years. Now, what I have learned is that there are accounts out there that do exist that do yield a higher rate of return than the numbers that you listed. But not only that, it's not affected by the ebb and flow of the market, the downside of the market. Okay. So in other words, that money that you're putting towards that particular account is protected. It's protected from the downside of the market and is protected from further taxation legally. The other thing too, taxation. Our money goes into 3 different taxation categories, whether we want to admit it or not. Hey, we can't get around the IRS. We either going to pay them on the front end or they're going to take our money on the back end and they're going to take it in death. But we have no choice in the matter. All right. That's We just got to deal with that. However, when we learn better, we can strategize better. Is that true? So what I learned 5 years ago is that you have the tax now category, which is things like your checking accounts, the savings, the CDs, the stocks, different things in the investment realm. This particular category says that the gains that you make on that money, at the end of the year, the IRS is going to tax it. Give you an example. I met a young gentleman about 3 years ago, and we were having a conversation about money. And he said, "Oh, I made $80,000 in the market." I said, "Okay, well, that's great. Is it taxed?" And I said, the reason why I'm asking that question is because the type of money you're referring to falls into the tax now category. So yes, you did make $80,000 in the market, but at the end of the year, it's not going to be $80,000 because the IRS is going to tax those gains on that money. Then you also have the taxation, the taxation category referred to as tax later or tax deferred, that you and I know very well, right? This is with your annuities and your pension plans, the 401ks, etc. The money that you put up front, obviously, it's not taxed. However, because that money is growing, it's supposed to grow for years, right? 20 years, 30 years. So now when you start to make a withdrawal, the IRS is going to make a withdrawal in taxes as well. Then you also have the tax advantage categories. This is what some people refer to as non-taxable. So what that means is that you put the money into this account, it's taxed up front. So we call it a seed, right? The seed is taxed up front. But when it develops and blossoms into a tree, and now you start to pull from it, you pull from it penalty-free, question-free, and it's non-taxable. This is how generational wealth is built. This is how people that have a revenue of businesses or a large arena of businesses and a lot of revenue coming in, they put it into the tax advantage categories because their money is protected from further taxation. And there are many different accounts that applies to all three of those taxation categories. And there are accounts out there that do yield a higher yielding rate of return. So I know I said a lot. I'm going to be quiet, but I'm really loving the conversation. So thank you for.
Oh, no, don't be quiet. This is good. This is what we're here for. And so the rule of 72.
Yes.
Okay, fantastic. Thank you so much. And I know that we have, a lot of folks that are, I'd say, good stewards of their money, particularly here in the city of Glenarden. And we have a lot of retirement homes here as well. And I say that because Glenarden is one of those places where you can be born here, you can change 3 different job categories here, and you can retire strong here. So this is one of those areas where, and this is what we talk about when you are in that retirement phase, where you live determines how far your money will stretch. And that's the beauty of the city of Glenarden, is it's in probably one of the lower tax brackets relative to in Prince George's County and the other 27 of all the 27 municipalities, but it's also in a direct location space to activities and other different things, and not to mention the county seat. So it brings to you a equitable value where you're not only your money is going further because you're in a lower tax bracket, tax base, forgive me, but it also allows you to still have that lifestyle of that entertainment and, excitement and the zoo and different things. My family has 80-acre farm in Mississippi, and the home house sits on a large sum of it, and then a greater sum of it is just forest. And my father was a fisher, so he dug a pond, hit a natural spring, and now that thing is like 60 feet deep. It's crazy. But we each child in their passing was eligible for an acre of land. And that's something else that, while we're in Maryland and the areas here, you don't really have a lot of land mass. But that ability to choose a location that has a tax base that allows your money to go further. And a lot of people don't think about that. They think about the excitement and the activities and who's close by. But really, think about how to stretch your money, because what you really want is in that next 10, 20 years after retirement to really start building that generational change in wealth. And if you're like me and my husband had children really late in life, we're building not only our generational retirement wealth, but we're building our children's next phase of wealth. That's why that 50,000 kind of hit me, as a relative achievable thing, because I think we all at least now have a $50,000 car. If you've got a Toyota, it's $50,000. I remember my first Honda CRX, it was $13,000, and we thought we was going to have an emotional moment. Now we're riding around in $80,000 BMWs. It's crazy,
isn't it?
I do want to just say those things about where you live and your tax base for our young working adults who are within their 7 to 10 year. Please, your next 10 years matters greatly, right? When we came out the military, we had a decision point. Every 10 years, make a choice. Every 10 years. When you get to 15, every 5 years. And then from 20 plus, you continue every 5 years, because that's how the markets change. And that's also how your lifestyle will change based on what your interests are. So we do a lot of playing in that first 10 years. That's why I say don't really touch that. If you can pull 50,000, pay it off in 5 and let it make you money over the next 10, 13, 16 as you talk to, then leave that in the bank. That becomes your nest egg.
Yes. And I mean, oh my goodness, you've been to our workshops, haven't you?
No.
Our workshops. But you're absolutely right. Let's talk about the retirement. When you're 23, you're not thinking about retirement, but you should, right? So I'm glad that you said that to the younger folks that are listening. At 23, you have to start preparing and planning for what's going to happen that you can't see when you're 43. I'm a breast cancer survivor. I discovered the lump in my left breast when I was 43. It was the morning of my 43rd birthday. Who saw that happening? Now, for me, as you know, my journey was different financially because I was already on active duty. I was in the military, the benefits. I didn't have to pay. I wasn't worried about losing my house. I wasn't worried about having food on the table. I wasn't worried about bill collectors coming by. I wasn't worried about anybody repossessing my car because I had to pay all these bills to save my life. I didn't have those worries. But the truth is, Mayor Cashenna, and you know this full well, more than 60% of bankruptcies are as a result of medical bills. But we can do something about that when we start earlier in life. That's why financial education is so important. It's good to play. I played a lot. But now in my later years, I'm learning, okay, I played a little bit too much and I should have been saving and learning about how to do better with my money for me and my husband both. So, you have to talk about that because you're able to work now, but who's to say that you're not going to have an accident on the job that you can no longer afford to work? What's your plan B? So we do have to talk about that. Things look a lot differently in retirement. The check is not the same. I learned that from my husband because he retired first after 21 years in the United States Air Force. And I said, oh, honey, just take your time. Just relax. Just enjoy your time. Commemorate your service. Blah, blah, blah. Yeah, don't worry about it. You ain't got to go back to work no time soon. He said, let me explain something to you. I was like, uh-oh. He said, you don't understand. He said, I'm not getting the basic allowance and subsistence. I'm not getting the clothing replacement allowance. I'm not getting, the other subsidizing elements of money that I used to get. And I thought about it for a second. So, oh, okay. I understand now. It's a lot different. You know, the money that you're making or the money that you're going to recoup in retirement is a heck of a lot different than when you were working. And you have to account for that. And you have to account for a large portion of that on your Medicare plan. What is your Medicare plan? Medicare is not to be confused with long-term care. If you're a veteran, yeah, you got the VA, but the VA benefits are not always guaranteed to be there for us. They're not. They yank it around like a yo-yo. They really do. So you can never be too sure, but you need to start building up that nest egg, as you said, because you never know what's going to happen. So that's my bit of sharing. I'm glad you brought that up.
And also you push my mind to think about the insurance piece as well.
Yes.
Insurance, when you think about the medical long-term care, and when you said that, I said, and what about your insurance payments? That's something that a lot of us cheap out on early on.
Yes.
We don't get it. We think we're going to live forever. And we get the cheapest insurance, and we don't even get, personal liability. We just get the collision. We have the $15,000 deductible on it. Too much to pay for while your car still busted.
Right, right.
When I came through the military, I don't know what, no one taught me this. It just was life, and I just did it right. I always kept my deductible zero. That's something I suffered through. And, you got to find where your sacrifices are, because what I knew is if I didn't have my ride, I didn't get to work. And where I went to military bases, they didn't really have like a train system. No. You needed a car. In Moody Air Force Base, Mount Austin, Georgia, you needed a car.
Air Force Base, Louisiana, Shreveport, Bossier City.
Yes. So that is something that I think just developed because of circumstance and environment. And I've just always kept it that way. I don't like to have my insurance payments. I will pay $1,500 for my insurance to be at zero. And a lot of people say, well, that's just wasted money. Yeah, until you have an accident. And nowadays with younger drivers getting on the road, we don't do driver's ed like we used to when we grew up. So, grandma or dad or mom taught you something in some parking lot, and then you went and took a test, you passed, and now you're driving. So, I mean, it's gonna happen. You're gonna get hit.
Yes. Yes.
And that's something, when we're talking financials, people don't put insurance in there, but you need to put insurance in there. Life insurance, whole life.
Yes.
And term life. Make a portfolio.
Yes. Yes.
Do you have advice on life insurance?
Oh my goodness, do I? So first of all, there's no type of life insurance that's better than the other. They all have their advantages and disadvantages. It all depends on what the client is looking for, what the person has their mindset and their goals on. What I will tell you, there are two different types. Basically, you have the term and you also have permanent. So we refer to the terms, obviously, as the name implies. You have the life insurance. Now, the term life, you have it for 10 years, 15, 20, 25, 30 years. And what that term means is that for that specific period of time, you are going to pay X number amount of dollars for a certain number of coverage. So maybe it's $25 a month for, $250,000 coverage, depending upon your age. So terms typically tend to be more economical. However, at the end of the specified term, let's say at the end of 20 years, that's when the premium rates on that life insurance will start to increase. And they will increase every year after that, to the point where, Mayor Cashenna, you're going to be 65. Guess what? Your insurance at that point is going to cost you too much. You may not be able to afford it. Not only that, 65 looks a lot different than 35, obviously. A lot can happen to your body and will happen to your body over that course of number of years. Maybe you'll still be insurable, maybe not. But either way, it's going to cost you more the longer you wait. Then you have permanent life insurance. So there are many different categories. You mentioned whole life, which is the traditional type. You also have other types of whole life insurance policies as well that also build up the cash value. So for a lot of people, that's very attractive. I know it was for me. You know, when I learned 5 years ago about the different types of life insurance options, I said, you know what, if I'm going to pay life insurance, I'm going to get something out of it. There's going to be some money growing somewhere. I'm not going to just be paying into it and then it's just a payout when I die. No. What about if I want to be able to have an additional source of money to grab from? Penalty-free, question-free, non-taxable. So you have the permanent life insurance that gives not only just the benefit of you being covered your entire life, but also having that cash value that's accumulating over time. So what I like to say about life insurance is that I wish I knew now 25 years ago what I now know. I wish I knew it 25 years ago. And I wish I was smart enough, Mayor, that even if I did know 25 years ago, that I would have been smart enough to do something about it. Life insurance, and I'm seeing it as I'm on this side of the fence now that I'm in the financial industry, helping put money back into people's pockets and helping them build their future. I am starting to see stories, you know, not so good stories and success stories. I see the success stories of people who they did put in that $1 million policy 5 years ago, and all of a sudden, when the spouse fell dead of an embolism, they were able to enact upon it. And the only thing the other surviving spouse has to worry about is making sure that their son or their daughter is just college bound. You know, they're just in that mindset of preparing that child for college. Nothing else. Nothing else. No other stressors, no financial stressors, no probate fees. They don't have to worry about that. So, but I also see it to where I had a 35-year-old client who we did a term policy for him, you know, newlywed, expectant father. And long story short, it was only for about maybe $30 a month. Not that much coverage, but it was something. I was told that they couldn't afford it, so they let the policy lapse. Several months later, when I called and checked in on this person through a family member who's a friend of mine, she said, oh my goodness, he had a heart attack. 35 years old, had a heart attack. And a brand new baby and a new wife who's not working. So now the question is, oh my goodness, didn't we do something for him? I said, we did, but they let the policy lapse. And I even dropped the coverage amount so that it could be affordable for them. Two things we make sure of: that it's affordable and that it's suitable for the client. I mean, what good is it to put somebody into a $500,000 policy knowing they can't pay it? That's not fair to them. That's not fair to that family.
No.
So that particular family, I don't know what happened, but he had a policy that he would have been able to file a claim, and he would have been able to retrieve X number of thousands of dollars that would have helped the family with their financial stressors. Maybe they could have paid off a year's worth of rent. Maybe they could have paid off some other debts that were outstanding. And all he had to do, Mayor Cashenna, was pay like $30 a month before life happened.
You know, it's so tragic because life insurance is one of those faith-based things. It's a faith-based thing. And we just trust that it's going to be there when it's time for us. And so we pay into it, just like insurance on your car. It's a faith-based thing. You pay into it because you're going to trust when you have an accident or your house has an issue, water damage, fire, whatever, that your life gets to be reset. That's what you pay into. And this is something that I really want. You grown folks need to hear it over and over again, but young folks have got to believe it.
Yes.
Those things are not optional. The younger you start a life insurance policy, the cheaper it is. So when you are healthy, strong, and vibrant, you can get a $10,000 to $150,000 whole life policy, and that can protect you well past age 80. And then therefore, when it's paid and done, that money's just sitting there for your family. And if you do whole life, then consider this. The worst that you would have to pay is maybe $200 a month. Most of us can get $1,000 a week job.
Mm-hmm.
Most of us, even part-time, will make $1,500 every 2 weeks. You're going to make $3,000.
Yeah.
If we start to budget, and I would say use a sprinkling of Dave Ramsey's, use a little bit of Miss Jeffries, and use a little bit of all these nuggets from mom and dad, and everybody's kind of teaching you, build your portfolio that's right for you. Because what you want is a lower initial rate that does not increase over time. And if you have whole life, I always advocate at least getting 100,000 in whole life, because that's just like that 50,000 I talked to you about, and you got 10 years and now it's almost 80,000. If you use the rule of 72, you just might have 100,000.
Mm-hmm.
You can borrow against your own money. And now you're not going to the bank taking out money from some lender. You are the lender.
Right.
You just changed generational curses. You started living biblical principles. You're not borrowing from anybody else and then breaking friendships. You're borrowing from your own self. And not only that, but you are set up in a way that you don't have to have the medical exams. You don't have to have the coverage period lapse. You get consistent and persistent and put that stuff on auto pay. When you need it, it's there for you. And that's what this is about. We called it surviving the summertime splurge. But what we really are interested in this particular mayoral forum is to ensure that we do not allow another day to go past, that we don't talk about the first steps of increasing our resilience. And in doing that, it is the anticipation and understanding why we have financial issues and changes, ebbs and flows, that makes us a stronger, wealthier, less health conscious individual in the future. So we are changing generational curses. We are building net worth, and we are building literacy. And I want you to tell us a little bit about your company so people can reach out to you. How do they reach out to you?
Absolutely. I can be reached at my number. I don't mind giving it here. It's 240-210-4489. That is the easiest way to reach me. You can call or text or leave a voicemail and I will respond back. I also have an email, Michi, M as in Michael, EECHIE, Jeffries, JEFFERI, S as in Sam, @gmail.com.
Fantastic. Thank you so much. We are moving the mission forward for our families, for our youth, for our young adults, and even for our experienced community members. We're always in a learning phase here in these mayoral forums, and that's the reason why they were crafted and created, to build an advocacy for resilience and build an advocacy for maximizing our potential in our communities. We are raising community awareness. And Ms. Jeffries, I want you to know that this mayoral forum has been quite enlightening for me. I am so honored that you have taken this time to spend with us, to run some math numbers, to talk about portfolio. We didn't talk as much about stocks because, okay, I'm not a stocks player, but I do have stocks, believe it or not. They're low risk stocks that, you know, they're probably not making me too much money.
No, they're not.
But
no, they're not.
It allows you to kind of diversify your portfolio. Are there any final words on our financial literacy forum that you would like to communicate here?
Yes, absolutely. I come bearing gifts, not just what I shared, but I also have financial reviews that are free. Mayor Cashenna, you are one of the recipients as a result of this. So you have your free financial review waiting for you. We also have free workshops, and we have a huge seminar in our office in Greenbelt, Maryland, that's going to be happening next weekend. All are welcome. It's going to be fun, food, friendship, networking, you name it. And I also have free resources as well, some books that coincide with our educational platform. All people have to do is just reach out to me, and I can go anywhere and want to go anywhere to share more of this knowledge as well. So thank you.
Thank you so much. And let us have that number again. They can
Sure.
text that number as well.
Yes, yes, yes. So it's 240-210-4489. They can call, leave a voicemail or text.
Our financial advisor, ladies and gentlemen, Ms. Michi Jeffries. Thank you so much. I'm Mayor Cashenna A. Cross. And until next time, you keep moving the mission forward. Thank you.